We are in the middle of a massive technological arms race. At the center of the global artificial intelligence boom is a relentless demand for computing power, meaning the semiconductor manufacturers who actually build the hardware hold all the leverage. In this ecosystem, Samsung Electronics is a foundational titan. Their quarterly earnings act as a thermometer for the entire tech supply chain. This chart shows Samsung's profit leap from the previous baseline. The bar scales up dramatically, revealing a staggering 19-fold increase in profits. By any conventional metric of finance, multiplying your profits 19 times over triggers absolute euphoria on Wall Street, followed by a massive surge in stock price. But the exact opposite happened. The moment Samsung released this record-breaking news, their stock plummeted. The sell-off was immediate and contagious. The drop rippled outward, pulling down shares of major rival chipmakers like Micron and SK Hynix right alongside them. Why did a tech giant multiplying its profits 19 times over trigger an immediate global market panic? To understand the disconnect, we have to look at a well-known market dynamic. Buy the rumor, sell the news. Investors are inherently forward-looking. Months before the earnings report came out, they had already priced a flawless, miraculous performance into Samsung's stock value. In a hyper-speculative environment, even a reality where you multiply your profits by 19 falls short of the mathematical demands of the current hype cycle. The problem goes deeper into Samsung's microeconomics. Unlike pure-play chipmakers who only sell components, Samsung is also a massive manufacturer of consumer hardware. This graph illustrates an inverse relationship inside the company. As the cost of internal AI chip production goes up, the profit margins for their own smartphone division are pushed down. The very components driving that record profit are cannibalizing their other departments. They are effectively squeezing themselves. Samsung's consumer divisions pay inflated prices to their own internal semiconductor divisions just to keep up with the physical demands of AI integration. For decades, Samsung's highly diversified corporate model was considered a defensive strength. Under the extreme pressure of the AI boom, it became a structural liability. Delivering that volume of hardware requires enormous physical infrastructure. You can't achieve massive profit scaling without building the factories to support it. Expanding that infrastructure exposed a hidden cost that caught investors off guard, sharply rising internal labor expenses to operate and maintain these new facilities. These rising operational expenditures directly eat away at the long-term bottom line, making future quarters look far less lucrative. Wall Street analysts often build sterile, fully automated assumptions into their models, but manufacturing remains a messy, deeply human endeavor. The financial projections drastically underestimated the friction and the physical labor costs of keeping up with a once-in-a-generation demand shock. The paradox resolves when you see it as a clash between the mathematical perfection of investor spreadsheets and the physical friction of a real-world factory floor. Zooming out from Samsung, these same pressures are mounting across the entire tech landscape, turning a single company's crisis into a sector-wide trend. The stock crash was a perfectly logical reaction from a market stretched to its absolute limit. There is an undeniable physical demand for AI hardware, but the market psychology surrounding that demand is deeply flawed. This graph tracks market sentiment. Notice the massive spike in volatility reacting to a microscopic dip in projected growth. Investor psychology is dangerously hypersensitive. We are in a phase where record-breaking financial reality can no longer support speculative expectations. The Samsung paradox serves as a vital warning siren for every investor and tech giant currently riding the artificial intelligence wave. AI has already established itself as a permanent structural shift, but as Samsung's crash shows, the stock market may have reached a speculative peak that physical reality can't keep up with.